Hey everyone, happy Thursday, August 6th. It's a little bit before 10 a.m. on the West Coast, and it's time for another market update. Well, as I'm sure you might have seen on the news, it looks at least positive about a deal being put in place between Iran and the United States and getting the strait back open, which, like we've talked about, is very important because the oil prices and the cost of oil goes up when that strait is being affected, and that definitely has an effect on our inflation and in our day-to-day cost of goods. So anything that gets that resolved is a positive thing. But as we all know, we've got to this point multiple times. There's been lots of false starts, it seems like, since this conflict started at the end of February, where it looks like there's going to be an end in sight. There is an end. They say there's an end, and then it kicks back in, and there's more conflict, and oil prices spike again, and that's not good for us. So the markets right now are kind of positive about it, but also holding their breath a bit to see how this transpires, what the details of the deal are, whether or not Iran is able to gonna charge some sort of fee for ships going through the strait, and things like that. So for now, good that there's a deal close to being done, but I won't believe it till I see it, and even then, I'll probably wait a week or two before I start to think any positive about it, because again, it just seems like just when we think this is over, it starts going again, and then negative things for mortgage rates. So end in sight, but fingers crossed that it holds. Next thing. So last week, the Fed had their last meeting, or their most recent meeting ended, and they kept rates where they're at. So they did not cut rates and they did not raise rates. So just kept where they're at. However, three of the 12 voting members, so the vote was 9-3, three members voted for a hike of a quarter point. Generally, that's more dissent than the Fed shows, especially for a new president. You figure they'd want to, kind of have a more of a solid front. But it just shows that a lot of the members are concerned about inflation and inflation getting out of control again. Obviously, a lot of that has to do with this war with Iran. The cost of oil has a lot to do with how much things cost in our country, and where inflation goes. So it makes sense that some of these members would think it would be prudent for a rate hike. But obviously, that's not what we want. That will not be good for mortgage rates. The opposite of what we want. We want them to start cutting that Fed rate, but like I said, with inflation elevated and the job market still showing some strength, it's a little bit more risky for the Fed not to cut or not to raise rates, and definitely would be risky to cut rates. So you understand where they're coming from, but at the same time, not what we want to see. And right now, actually, it's showing the markets. There's a ways that track this, what they think the Fed's going to do at their next meeting, which I believe is September 16th. Right now, it's about 55% chance they're going to raise rates. So it's tipped to the negative. It's gone to the point where now the markets are kind of thinking, hey, next meeting they're going to raise rates. So not what we want to see, and obviously the markets and mortgage rates and mortgage bonds and things like that is not something they're going to like. So going to have to keep our eye on that. But like we always talk about, a lot's going to happen between now and that meeting, with the war, with the inflation data, with jobs data. Who knows what's going to happen between now and then? Lots of things can happen. So just going to have to keep an eye on that. But for right now, the markets are predicting a rate hike coming in the middle of September. Next thing we got, so inflation. So we got the newest PCE report for the month of July, and that came in about expected. Headline was down slightly, 0.1%. Core was up slightly, 0.1%, leaving the headline at 3.7 overall, and that core at 3.3. Keep in mind that core number, remember the Fed's goal there is to get that to 2%. So quite a bit of ways from 2%. Not sure if that's even possible these days, but that was their stated goal. So that's still what we got to keep in mind. So still pretty elevated above that. So again, good that it came in as expected, I suppose, not higher than expected. But again, a lot of this is going to have to do with oil prices and the cost of goods in our country and things like that. So right now, inflation's still elevated. Still a chance for it to go higher if that war kicks back up. So this is what the Fed's looking at and saying, hey, core number 3.3% is way far away from our 2% goal. We definitely can't cut rates right now. What if we raise rates? Maybe that'll get inflation down. So that's where inflation lies. which again, not good, but could be worse, I guess. So we got to keep an eye on that. And then the second part of data that we know the Fed's keeping a really close eye on, besides the war, besides inflation, is jobs data. And tomorrow we're going to get the BLS jobs report, which is the big one, the most important one, the one that can have the biggest effect on the markets and gives us our unemployment number and things like that. But we did get ADP, which is private payroll data this week, and it was lower than expected. Came in lower. You can see basically more than half of what June was at 44,000 jobs created. Pay increase did go up for job changers, which is inflationary. The more we're making, the more we tend to spend. So not necessarily a positive error. Good for those people that changed jobs and got more money. And then annual pay increase for job stayers stayed where it was at. So again, not the weakest report, but definitely not a strong report. So maybe an indication that tomorrow's BLS jobs reports will be a little bit weaker, which again would probably alleviate mortgage rates, be positive for us a little bit. So next thing, so where does that leave us? So last time we talked, the average conventional had gone all the way up to 6.85% for, according to this lender survey for really good borrowers, good down payment, things like that. According to it today, we're at 6.75%. So we have had some positive with this war possibly coming to an end, or and then the Strait being reopened. So we had some positive there, but again, end of February when this all kicked off, rates had got down to 5.99, and now we're at 6.75 and this is actually, I think I saw today, this is at a 2-week low at 6.75. So you can play games with numbers and time. So it's great. It's a 2-week low, but it's also 6.75. So not good there, going the opposite direction, positive direction, I guess, now from 6.85, but still far off from where we were just a few months ago at the end of February when we were at 5.99, closer to 6. So need that to start coming down. That will definitely help the industry. People are sitting on the sidelines, not wanting to buy houses. Maybe they're priced out. Maybe they just can't afford it where rates are at right now. So anything that helps rates will help the industry and help get more houses sold. So fingers crossed there. Next thing, so where does that, upcoming dates? We got, like I said, tomorrow we get that BLS jobs report. That's a very important report. We'll have to see where that goes. And then we get the Fed's next meeting is in middle September. So, like I said, really, these reports are important, but right now we need that war to come to an end. We need it to get resolved. We need it to be resolved permanently, and get commerce going through that strait again. And then maybe by the time we get to that mid-September meeting, maybe we see some change in the how the Fed members feel, how the markets feel as far as that rate hike going, because we do not want them to hike rates in September. That would not be good for mortgage rates. But again, you could see why some of them are thinking that, with the war going on and inflation going up, because the worst thing that could happen would be, we made progress on inflation over the last few years, but if we cut rates too soon and we let inflation get out of control again, we're back to square one. We're back right where we started, and no one wants that, myself included. So if anybody needs anything at all, or if anybody has any questions, please don't hesitate to reach out. Thanks a lot, guys. Have a great week.